It's time for the Your Personal Bank Show with Ferenc. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. One of the questions I've been getting asked recently by a lot of folks is this. The Federal Reserve recently lowered interest rates about a quarter point. A lot of people thought that mortgage rates would go down slightly, but what actually happened? They went up. Now, it is true, majority of the time when the Federal Reserve lowers interest rates, borrowing rates across the board, bond yields, etc., do tend to go down. But we're in different times now than we have been in the past, and the big difference is the historic levels of federal debt. And what has happened is the Federal Reserve has lost the longer end of the yield curve, or in other words, the longer term bonds. They've lost control of that. Again, it has to do with the debt. The federal government, when they spend more than they receive, which they are continuing to do, plus have over 37 trillion of debt on the books, they have to sell that debt when it comes up for renewal. They sell debt in time frames of anywhere from 4 weeks to 30 years and everything in between. We all know the government doesn't pay back its debt. It just refinances or rolls over that debt, those bonds, when they come due, and they pay the current interest rate, whatever that may be. When you have historical levels of anything, this is basic economics 101. When you have historical levels of something you have to sell, like bonds, what do you have to do to get the buyers to buy it? How do you entice them? Well, you increase the interest rate. And that is why the longer term bond yields are staying high. In fact, when the Fed dropped interest rates, the longer term, the 10 and 20 and 30-year bond rates actually went up. The reason is simple. The bond market doesn't believe that the federal government is serious about reducing their debt. Neither does most anyone who thinks rationally, because obviously not only are they not reducing debt, they're continuing to pile on by spending more than they receive each and every year. Now, this all creates an opportunity. You have a very unusual situation, I'll put it that way, of shorter term interest rates going down a little bit because the Fed did indeed reduce rates. They're also projecting to lower them again later this year. And although it's hard to predict what's going to happen in the future, it seems to be fairly clear, at least in the shorter interest rate side of things. And here's why I say that. Federal Reserve is under political pressure primarily to reduce interest rates. They used softening jobs as the excuse, but let's face it, we're at valuations historical highs with the stock markets, real estate. Inflation is still about 50% higher than the Fed's target rate of 2%. It's floating at about around 3% according to the government numbers, yet they reduce interest rates. If you looked at all the numbers, you would think they wouldn't be reducing them. In fact, they might be raising them, but they did the opposite. Now, Federal Reserve Chair Jerome Powell's term ends in May of 2026. Trump has been very vocal about wanting to reduce interest rates, and he's already picked a successor to do so. And that successor in May will very likely reduce rates further. So that's the most likely scenario we're dealing with going forward. And if you put yourself in Trump's shoes, you understand why he's so adamant about wanting to reduce rates. And not just him. Treasury Secretary Scott Bessent has echoed the same type of thing. High interest rates are detrimental to the borrower. Who's the largest borrower in the world right now? The federal government. So they need lower interest rates so they can lower the interest that they have to pay on this debt. Now, they don't really care if the interest rates are down across the board, short and long term. They just need to have lower interest rates somewhere so they can sell all these bonds. And they're pushing for the shorter term time frames, like the 2 years, let's say, and under, maybe 5 year. And if they can get the Federal Reserve to push those rates down, they can resell the debt that renews each year and the new debt that's getting added on. They can sell those bonds and pay a lower interest rate because the Fed is pushing those rates down. That'll save a ton of money for the federal government because currently interest on the debt is one of the largest expenses the federal government has. In fact, they're currently paying more in interest on the debt than even the Department of Defense, or now the Department of War. So this is a big, big deal. Now, again, this creates an opportunity. This is why I continue to express the fact that this is the golden era of fixed assets. Higher interest rates are generally good for those who are investing, but bad for those who are borrowing. Also tends to be poor for stocks, businesses, higher cost of borrowing, real estate, estate, etc. The golden era fixed assets, you get a higher return, dividends, that type of thing. My point is, your personal bank, for example, and annuities are seeing the highest levels we've seen in 40 plus years. It truly is the golden era. If you're looking to get some guaranteed returns, safety, all that good stuff, unlimited upside, by the way, annuities can continue to offer that for you, index life, index annuities, while protecting the downside. That's a tremendous combination. My point is, though, it's even getting better because as we continue to see the longer term rates rise, that means dividends will continue to rise in the future, returns with annuities and your personal bank policies, dividends that is, while the borrowing rates against it will be lower, which creates a larger spread. The cost of borrowing when you access the money. If you're earning more in interest than it costs you to borrow or access, you get to keep the difference, that spread, or what's known as positive arbitrage. We're already at positive arbitrage, but we're quickly moving into a position where we're going to be even more of that. And from our standpoint, that is exciting. Now, the general financial picture of the situation isn't great. I sure would prefer to have a lot less debt, our government, but unfortunately, Congress has so far been unwilling to reduce debt spending in any meaningful way. So this is a problem that's ongoing, and most analysts have projected, and I'm talking about JP Morgan, Vanguard, BlackRock, you name it, have all projected that dividends, fixed assets, interest rates, and such will continue to be high for the next 5 to 10 years. In fact, the Federal Reserve has now just come out with a report stating that they predict inflation will continue to stay high for the next 7 years. These are some very credible sources stating these things, and they have some very valid reasons. Like I said, the debt, the bond yields, interest rates, all that higher for longer. We're very much likely to see that. The first question I was asking is, why did the Federal Reserve lower rates yet mortgage interest rates went up? It's because mortgages are not based on the Federal Reserve. They're based on the 10-year Treasury, which is a longer-term debt instrument. I just explained why the longer-term debt interest yields and such are higher and continue to stay higher because of all the debt. In fact, you take the 10-year Treasury plus 2 to 3%, and that gives you the 30-year mortgage rate. If all these analysts and the Federal Reserve are correct, that means interest rates, mortgage interest rates that is, or any longer-term type debt, let's say anything around 10 years or longer, are going to stay higher for longer. Again, if you're borrowing, that's bad. If you're investing and you want an interest or dividend return, that happens to be good. While all this is going on, the other news that's happening is, of course, the stock market continues to climb. In fact, the Buffett indicator, which is a measurement of the total market cap of the U.S. stock market to GDP, has now hit about 220%, which means the stock market is valued at over 2.2 times larger than the entire U.S. economy. This is the highest level ever recorded. It's way higher than it was at the peak of the dot-com bubble. In fact, over 50% more. And Warren Buffett has often been warned that if the ratio approaches 200%, as it did, of course, in 1999, you are playing with fire. And we are way higher than that. We're 220%. Most of this is being caused, as we know, by the AI exuberance. And this one article I read I thought was very appropriate, stating that the current AI bubble that we're in is not just a bubble. There are actually 3 bubbles, and they broke it down, which I thought was quite interesting. First of all, of course, AI is what's called an asset bubble or a speculative bubble. This is when asset prices soar well above their fundamental values. Classic examples happened with the dot-com era. This has happened many times previously. It goes all the way back to the Dutch tulip mania of the 17th century. There was a period of time, do you realize, that speculators drove up the price of tulip bulbs? Some of them were more valuable than a house at that time. Now, currently, NVIDIA is trading at about 50 times earnings. That means it has to make profits for 50 years to get back the value of its stock. Tesla is at over 200 times earnings, despite falling revenues. And the rest of the Magnificent Seven are all enjoying significant boosts in their PE ratios, well above what you would consider fundamental values. Now, the second bubble we're dealing with, as this article points out, is an infrastructure bubble. Huge amounts of money are being invested in infrastructure, data centers, that type of thing, without any certainty that it'll really be used at full capacity at any time in the near future. In fact, a great example they point out too is in the late 1800s, railroad investors built thousands of miles of unneeded track to serve future demand that never materialized. In the late 1990s, a huge amount of fiber optic cable was laid in anticipation of internet traffic demand that didn't actually happen in some cases till decades later. So many companies are pouring literally billions of dollars into power systems, cooling infrastructure, general computing power. It's a race to scale up data centers. There are commitments of over $1 trillion just in 8 projects alone, for example. This infrastructure building, will it turn out to be a boom and then bust like the railroads, laying far too much track? Or in the 1990s, the fiber optic cable that was laid decades earlier than before the demand was there? It's not unreasonable to think that some of this is going to be overbuilt. And then the third bubble they point out is a hype bubble. And this is the one I've probably discussed the most, is where the promises that are made for the new technology far exceeds reality or the time frame of when it will actually come into effect. It becomes increasingly detached from any likely future outcomes. You know, we all remember the hype around NFTs. That was a classic hype bubble. There was a lot of hype around the dot-com bubble. It promised fundamental changes to our economy, which did, for the most part, actually happen, but not till a decade or so later. And I've pointed out on the radio show the recent MIT study pointing out that 95% of AI pilot projects have failed to generate any returns whatsoever. There's been several studies since that have echoed that. Now, the reality is, are we in a bubble? I think it's logical that we are. The real question is, how long will it last? That's the one no one can answer. How long? How fast? And then when the correction comes, how aggressive will it be? How far will it go down? And how long will that last? Those are things that no one knows. But here's what we do know. Just like in the fall, when the nights start to get cooler, the leaves start changing colors, we know fall is coming, and we know winter is not far behind that. We know the season. We don't know the exact date that, say, winter starts, when the first snowstorm hits or the first freezing night is going to happen, but we do know it's coming, and it's coming soon. And I think that's where we're at right now in this AI hype bubble, euphoria, irrational exuberance, whatever you want to call it. Could it continue to go up from here for another year? Yes. Could it turn around on a dime and crash hard in the next week or two? Yes. It could do either of those or anything in between. We're certainly in the season, and I'm going to encourage you to stay tuned in the next segment, because I have some other things to share with you that really kind of illustrate that the cracks are really starting to show that we are definitely in the late stage of the most aggressive, highest bubble ever in stock market history.
Stay tuned for more common sense from Ferenc. For more information, contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me at yourpersonalbank.com. If you missed the last segment, I'm going to really encourage you to go back, because I was sharing some things about where we're at, the 3 bubbles that we're in that help create literally the largest asset valuation bubble we ever recorded in stock market history. I'm going back to like the 1840s, folks. We've never seen anything like this. The valuations, regardless of how you want to measure them, are higher than they were in 1929 or 1999. Now, there's some cracks starting to form in this bubble that we're in, this hype that we're in, or exuberance, whatever you want to call it. US IT spending is surging back to dot-com level eras. The last time the percentage of GDP hit these levels happened to be in 1999. We have now matched that. Shortly after that, the markets took a crash and they dropped top to bottom. Well, the NASDAQ dropped 72%. If you remember. Now, this is a measure that's been tracked for decades. Tech investment has rarely been this elevated, and the previous times it has, the results thereafter were not pretty. Now, the other issue with that is the tech spending has really become the backbone of the U.S. economy. Deutsche Bank pointed out recently that without it, GDP growth would be hovering near recession levels. You see, tech spending right now is really masking the fact that the economy is probably in a recession. Certain states are. About a third of the states actually are already in recession. About a third are teetering on it, and about a third are not. There's a concentration or bifurcation happening in the economy right now that's rarely ever been seen. The concern is the concentration that's occurring, because all this tech spending is really only happening with a handful of companies. And that high level of concentration creates a lot of risk, especially if one or two of the primary players start to back off, skip a beat, run into a challenge, delay. Any kind of challenge could have an outside influence on what happens because there's so few players. What a lot of analysts are stating now is AI investment has bought the U.S. time, but the economy can't rely on this parabolic tech spending forever. And to illustrate this further, the top 10 stocks now make up 41% of the S&P 500, which is an all-time high. The Magnificent Seven have also hit a new record of 35%. So out of the 500 stocks in the S&P 500, only 10 are driving the entire index. The rest are pretty much marking time. And this isn't just anecdotal evidence. I've seen this myself firsthand. We're seeing tremendous returns like in the S&P 500, but they're really concentrated just in the tech sector and really, like I said earlier, in these 10 stocks. And when I look at somebody's statement, and I probably on average look at 2 or 3 statements a day. So if we just take the last year, 200 working days, let's say, I've probably seen, I don't know, 400 or 500 statements. So I think I have a pretty good measuring tool, if you will. Now, certainly the most common thing I've seen with folks with portfolios or index annuities for that matter, or index life, a lot of them have seen, 18, 20, 22% or more returns over the last year, for example. But if you dive deeper into it, if they were in this tech area, like in the S&P 500, they saw those. About a third of the statements that I have seen were folks that did not have exposure to the tech sector. And unfortunately, their returns, frankly, are, most of them I see about 3 or 4%, which is pretty pitiful compared to what could have been. And as I was speaking to one potential client just this last week, they were really frustrated because we were looking at their returns over the past 5 years, in fact, in a portfolio that had really no exposure to the tech. Her returns over the last 5 years averaged about 3% annually. And again, that's about a third of the statements I look at. So not everybody who's even invested in the markets or have portfolios are taking advantage of this historic run-up. In fact, of all the statements I've seen in the past year or so, I can think of only 2 where they had put a substantial portion, if not all of their assets, into one of the 10 companies. Now, it's highly risky to do that, but it paid off for them, where they had 100% returns on their money. But that's because they basically put it all in 1 or 2 stocks, and they happened to pick the right ones that just took off in the tech sector. But unless you had a substantial portion of your portfolio invested in that arena, your returns, frankly, for the last few years, have not been all that great. So this run-up has not been the panacea that many people would think. I talked to a lot of these people that are frustrated because they don't seem to see the returns. They're seeing these crazy numbers, yet they're not seeing in their portfolios because they got a balanced portfolio. They're spread out all over these different areas, and little or limited amount of their portfolio, if any, has been exposed to tech. It's really been a high risk, high reward type situation. And that increased concentration is continuing to increase the risk. And to give you an idea, the weight of the largest stock of the S&P 500 has now just hit the highest level ever recorded. NVIDIA, with a PE ratio of over 50, as I stated earlier, it means it takes 50 years of profits to equal the value of its stock, which is extraordinarily high. Anything above 30 is considered high typically. But NVIDIA by themselves, that one company now accounts for over 7% of the entire S&P 500. I'm not saying this is going to happen, certainly, but what if NVIDIA stumbles? Or, as I was stating in a previous show, 40% of NVIDIA sales happen to be to 3 companies. So there's 3 companies driving NVIDIA's sales and their profits. What if one of those 3 companies decide, we need to back off, or we can't afford to continue, or whatever? They run into some kind of delay or challenge, or just change their direction, change their focus. Guess what? NVIDIA is going to suffer. And that's why Kathy Wood, who's a famous investor, stated recently, the AI race has already shrunk to the big 4 key players, and she thinks it could soon drop down to just 2. If one of those 4 big players step back, the results for, say, NVIDIA's profits could be devastating. And they happen to be the largest stock in the S&P 500 and really been the poster child of this AI exuberance that we've been seeing for the last couple of years. It could cause catastrophic results just in the sentiment. Remember, the price of a stock is not what it's really worth. The price of a stock is what someone else is willing to pay. And a lot of that is driven by fear and greed, emotion. Fear can be the fear of losing, or it could be the fear of missing out, but it's that human emotion. And when that shifts, then you can see some really aggressive changes. All I'm saying is you need to protect yourself from that. In my opinion, if you are exposed to this risk, at least consider reducing that risk, reducing that exposure as this exuberance continues to play itself out, because it could turn on a dime and it could turn very quickly, even faster than you can react, frankly. A couple other reasons why there's some cracks starting to form in this AI exuberance that we've been experiencing. According to Axios, adios. AI work slop sabotages productivity, study finds. So what's happening is a lot of folks who are working are finding out that, memos, reports, emails are clogging up employees' lives and wasting their time, because sometimes people are just using AI to respond to even an email or a report, and there's a lot of words in there, but it's not necessarily well thought out. Then they have to go back and fix it or adjust to it, or it's taking more of their time. So in fact, the promise of AI being a time saver or productivity enhancer, well, at least so far, for many employees, it's been the opposite. It's in fact wasting their time and being a productivity inhibitor, because it just doesn't have the logic to really think through. It's smart, it's intelligent, it's great at researching, but it doesn't think through ideas and thoughts very well, at least not yet. And the other cracks that are starting to form, which is, I think, is going to affect the overall economy, is the cost of electricity is going up. In fact, we've seen since 2020 a significant jump in the average cost of the kilowatt hour, and much of this is because of these AI data centers being built and sucking tremendous levels of energy. I saw a report recently I shared a couple weeks ago where 22% of all electricity being generated for the state of Virginia is currently going to data centers. Well, that demand for all that electricity, all that power, will drive prices up for electricity. What does that do? Higher energy prices increases inflation and does then negatively impact folks, especially middle class or lower middle class, because their cost of living goes up. That's in detriment or negative to the overall economy. So some of the increased productivity that we may receive from AI that we haven't seen much of yet, but it may come about, may be offset somewhat by the higher energy costs. These are things that no one has really thought through, I don't believe, or if they have, they've discounted them. We won't know until it actually happens. These are some of the unintended consequences when you make massive major changes to infrastructure, major projects, whatever. There's unforeseen circumstances. That's the point I'm trying to get at. The last thing I want to touch on that I believe is a crack forming in the economy, and again, it's about concentration. Turns out that high-income Americans are now accounting for roughly half of all consumer spending. In fact, the top 10% account for about half of all spending, which is the highest level ever recorded. Now, this is significant because you're increasingly relying on a small number of folks to continue spending to keep everything going. And by the way, to be in the top 10%, you have to be over $175,000 a year income. Why also this is such a big deal is consumer spending is about 2/3 of GDP, or gross domestic product. So we have about 10% of the consumers accounting for half of total consumer spending, which accounts for about 2/3 of all GDP. So they're generating about 1/3 of the total GDP. That's a big deal. Small number of people that could have a massive outside impact, as I stated earlier, on what happens with the economy and the GDP and all that. And this article goes on and finishes stating that the bottom 80% of earners, which happens to be anyone under $175,000 a year, by the way, at this point, their spending has barely outpaced inflation since 2020. In other words, yes, their income has increased, but the cost of inflation has increased along with it, so their buying power has not changed. They've been marking time now for about the last 5 years. That is not the sign of a healthy economy. Even Federal Reserve Chair Jerome Powell stated recently that there are signs of an AI bubble. Remember Ben Bernanke, irrational exuberance from the dot-com bubble? Well, now we have Jerome Powell stating we have signs of an AI bubble. And then he also pointed out the economy is leaning too hard on just the rich. It's an unusually large amount of economic activity for just a few people, and that is very concerning for the Fed. It's a very risky situation. Things could change very quickly and very aggressively. Look, I hope they don't. I really do. I hope everything goes smooth. But I can't ignore the signs that are increasingly getting stronger, brighter. The alarm bells are getting louder, okay? We're getting closer to winter. All the signs are there. Like I said, the nights are getting cooler. The leaves are changing colors. We know winter's coming. We know we're in the season. We just don't know when. My recommendation, reduce your risk. Take some of the winnings off the table. Protect yourself. There are other options. By the way, you can even get into annuities today where you still can continue the unlimited upside with no downside risk. Why continue to take on the elevated risk from the concentration of the companies, concentration of the consumer spending? The consumer's actually still spending when you don't have to. If you want more information on that, how to reduce your risk while yet continue to benefit from the upside, contact me at yourpersonalbank.com. Stay tuned in the next segment. I got some more things I think you're going to find. Well, we're going to discuss some things about real estate that are very interesting too that I have not shared before.
Stay tuned for more common sense from Ferenc. For more information, contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. Been discussing a lot of the concentration of both the spending, the IT spending that a few, literally a handful of companies are doing. This is why we're seeing such a concentration in asset values. While yes, the markets still continue going up, the S&P 500, it's really only about 10 companies that are doing this, that are driving this. And if any one or more of those start to falter, that's when we could really see this AI exuberance bubble, whatever you want to call it, really start to change because it's such a small number of companies and it's so concentrated. Even just one company could have an outside influence and you could see some really aggressive shifts, catastrophic even, very quickly. Once sentiment changes, it typically changes quite quickly, and it would only require one or two companies to run into a problem, challenge, delay, whatever, to change that sentiment. So fair warning, be careful. Also, the economy itself is increasingly relying on a dwindling number of people. About 10% of consumers, the top 10%, are accounting for half of all consumer spending. That's 2/3 of GDP. That's a big deal. So there's only a few people spending money, and there's only a few companies that are spending money and growing, but it's a very small number in both cases. If either of them get skittish or have a problem, we could see a tremendous difference in the economy and the markets, etc. Be aware, proceed with caution, reduce your market risk. This is the golden age of fixed assets. I can't say it enough. You can take advantage of the continued upside. You can literally have unlimited upside potential with annuities, for example, with no downside market risk. Why continue to put it all in the line when you don't have to? And you could still take advantage of whatever upside that still exists in this current AI exuberance. And that's not me just saying that. Even the Federal Reserve Chair has pointed that out recently. Now, there's a few other things I need to discuss on this. And this is why I'm finding this to be such a big deal. I'm receiving a lot of calls now. People reaching out to me say, hey, I've been listening to some of the things you've been saying. Not a lot of people are sharing what you're sharing. I think it's emotional. I think a lot of people are caught up in this exuberance that we're involved in, and that's human nature. I get it. To be fair, it's hard to stay rational and calm in a time when there's a lot of excitement, a lot of enthusiasm, a lot of irrational exuberance even. We saw it in the dot-com bubble. We saw it in 0809 with the housing run up and then the crash. We'll see another crash again, I believe. That's my opinion, but history does repeat itself. A part of the reason why I think I'm staying rational is I do look at the facts. Look, I'm an optimist by heart, but I also understand I can't ignore things when I see it. Plus, folks, this ain't my first rodeo. This is my 26th year in the financial business, and this is my third time. Not a lot of people have that kind of experience. Some out there do, but not a lot do that are in the financial world. So there's that. Plus, I've experienced some of that stuff firsthand, personally. And you know, when you go through a really tremendous upcycle and then a crash, you learn some very hard and valuable lessons from that. I just want to repeat, I'm not saying the market's going to crash tomorrow. What I'm saying is we are definitely in the late stages of a bull market rally. That's increasingly obvious every day. We're in the season, like I've said so often, and I think this is so appropriate. No one knows the day. No one knows how long, how much, how far, any of that. That's impossible to predict. But you do recognize seasons. When the nights get cooler, when the leaves start changing colors, you know it's fall, you know winter's coming, and you know it's coming soon. You just don't know exactly what day it's going to freeze or what day you're going to get the first snowfall. But you do know it's coming, and that's what I'm trying to say. The correction is coming. We just don't know when, but it's coming, and it's coming sooner, and each day it gets closer. Just encourage you to protect yourself from it. Don't do what I've seen so many people do, where they ride the roller coaster up all the way to the top and whoop, over the edge, and down they go. And then what happens? They panic, fear kicks in, and if it goes down too fast, then they feel like, here's the really sad part, they feel like, well, now I'm stuck. I can't get out because if I sell now, I'm going to lose so much, so I got to wait for it to come back. Well, you know what happened the last couple times that happened? 0809 took 7 years to get back to where it was. The dot-com bubble took a decade. Remember the term, the lost decade? If you rode it from the top, went down, and came back, it took a decade to get back to where it was. Look, if you got a 7 to 10 years to wait for it to come back, okay, you can do that. But you do understand you just lost a decade. That's why it was called the lost decade. decade. In other words, you made no money, made no profit, made no gains. Well, I had folks in index annuities at that time or cash value policies and such. And when I did reviews in those time frames, guess what? I would do the review and I'd say, I've got good news and bad news. And it's funny when you talk to a financial person and they're invested with you, and it's amazing how everybody wants to know the bad news first. So I would tell them, well, the bad news is you made no money last year. I'm like, okay. I said, what's the good news? The good news is you didn't lose any either. And I'll tell you what, when the markets were dropping 20, 30, 40% in a year, which they were ecstatic. And I would often get questions asked, okay, I know you told us before, but how is it everybody I know literally is losing 20, 30, 40% of their portfolio values and we still have our money? So because its principal is guaranteed. That is a powerful concept. But let me take it one more step further that most people don't realize about index products, whether it's index annuity, IUL, which is index universal life. When you're in an index product, let's use a simple example, S&P 500 index product, and the market's going up, you get to take advantage of. We got products that offer unlimited upside potential. Folks, you're not giving up the upside. That's the part a lot of people don't realize. They think, oh my gosh, if I do an annuity or index product, I'm going to get up the upside. No, we have options that allow unlimited upside. Now, they also have principal guarantees. So guess what? When the markets go up, obviously you benefit. That's obvious. That's easy to understand. But here's the other benefit most people miss. When the markets go down, if you have an annual reset, which we often recommend, you reset at the new lower number. So the market goes down 10%, 20, 30, 40% even. Again, I've seen this firsthand with clients. When the market goes down, and then inevitably, what's it going to do? It's going to bounce back, right? You reset at the lower number, which means you get to grab the gain on the way back up after it dropped. And most importantly, you didn't participate in the drop. Guess what? Who has more money? Person with the index product, the index annuity, index life. Let me use a simple example just to run some very simple numbers to illustrate this. Let's assume for a minute you had $100,000 in an index annuity or index life product. And let's say that index went up 10% the first year. Well, obviously you'd have $110,000 in your account. Now let's assume the following year the market dropped 10%. What would your return be in the second year? 0. You didn't make any, but you didn't lose either. Now your 100,000 is still at 110. First year you went from 100 to 110. You got a 10% return. The second year the market dropped, yet you still keep your 110. But now you reset at the new lower number. Let's see, whatever that S&P index number is, and you go up the third year. Let's say it went up 10%. You would grab that 10% gain. So your account would go from 110 to 120. Actually, it's 121 and something with compounding, but to keep it simple, say it went up 10 grand, you're up at 120. Where's the person that wrote it up, down, and back up again? Back where they started. They would go from 100 up to 110, back down, and then they're back to 100. See the difference? You ride, you get to go up in the upsides, you don't go down in the downsides, and not losing sometimes is even more powerful than winning. I call it a stair-step approach to investing. Your account goes up each year or stays the same. So over time, it looks like up, flat, up, flat, like stairs. Versus the typical investment, which is subject to market risk, you see ups, down, back up again, down, up, down. You see what I'm saying? Looks more like a roller coaster. Look, do you want your investment portfolio to look like stairs? In other words, up or flat every year? Or do you want it to look like a roller coaster? Up, down, kind of thing. That's a decision you have to make. The objection I get is, well, there's limited liquidity. Well, with Index Universal Life, there isn't. You got access to 80% of the money. Let's say 2/3 to 80% of the money available within 30 days or less. You could access it anytime you want. If you're talking about an index annuity, you've got access to at least 10% of the money each year without any penalty or cost or anything like that. If liquidity is an issue, you don't necessarily need to put all your money in there. What if you allocated half of your money into an index annuity, for example? That's a simple transaction. It can be an IRA rollover. It can be a 1035 exchange. It can be done tax-free, no tax consequences, all kinds of stuff. My point is this. If you moved half into an index annuity and the markets went up, well, your annuity and your portfolio are probably going to go up pretty similar, especially if they're invested in the same type thing. You're going to see similar upsides. If the market stays flat, you're going to see similar returns. If the market goes down, that's the big deal. Your portfolio, anything subject to market risk, obviously is going to go down. The money in the index annuity would not. Now, you talk about liquidity. If you have 10% available in the annuity and you still have 100% liquidity in the other half of the money, you still got access to 60% of your money. liquidity at any given time. Is that enough? In other words, it's rare that if somebody needs 100% of their money available all the time. I mean, if you think about it, if you needed all the money all at once and you spent it, you wouldn't have any left anyway, would you? You'd wipe out your entire portfolio. How often does that happen? Hopefully never, right? And the only time you'd have, in most cases, that type of catastrophic, huge expense would be some major medical expense. Well, guess what? These annuities, these life policies have terminal benefits, living benefits, all types of things for medical reasons where you could have extra money available for those kinds of things to help take care of that and not tap your investment portfolio. So guess what? The one major reason why you would need access to huge amounts of money, most if not all of your investable assets, would be a large medical expense, long-term care, that kind of thing. And guess what? Annuities and life can help offset or even take care of those expenses. So it just takes that off the table. So the liquidity argument doesn't make sense. Think of your money in different buckets. I have a safe bucket that can grow. I have a risk bucket. That's called diversification. That's avoiding putting all your eggs in one basket. Look, if you're risk adverse and you want to put it all safe and you have enough liquidity, fine, you can do that and eliminate risk. But for those that still want to have some of both, why not have some of both? And I do that with folks all the time. In fact, I discussed that with a client just today where he's funding a chunk of his funds into an annuity, get unlimited upside gains, no downside risk. He's been funding a certain amount in each quarter. So literally within the next 6 months, he'll have funded one each quarter, doing partial 1035 exchanges, partial rollovers, keeping some of the money invested fully liquid and accessible, while the rest of it is in safe index products, unlimited upside, no downside risk, and he has access to some of that money every quarter. Just makes sense. It reduces risk, it reduces stress, and if we do indeed have a correction, this AI exuberance corrects. If half your money is safe, half your money is not going to lose, and then you'll be really happy you did it. But you have to do it before it happens, or it's too late without taking losses, or at least paper losses. If you want more information on this and how this could work for you, contact me at yourpersonalbank.com. I didn't get to the real estate stuff. I promise I will in the next segment, so stay tuned.
Stay tuned for more common sense from Ferenc. For more information, contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. See, here's the thing. I wish I could sit here and say, hey, everything's rosy. Everything's looking good. Economy's great. The markets are great and all that. And, you could just invest and roll and not worry about it. Well, you know what? The truth is we're not there. And every indication points out that we're at the end of a bull market, not at the beginning. This particular bull market we're in started in March of 2009. And at this point, we are about approximately 1,000% or tenfold increase from that time over the past 17 years. The move since April of 2025 has been about as parabolic as the market has ever seen. And this is typical when you get to the very end or when you approach the tippy top. Now, this is also the time frame where the emotions kick in and they're the strongest and it's the toughest time to step back because you get that belief that, well, we can't lose, or this time it's different, or AI is going to change everything. We heard that in the dot-com bubble. We have Wall Street telling retail buyers just to keep buying and keep buying. You know what? They're selling. The PE ratio is currently double its 100-year historical average. The Buffett indicator is at about 220% or 2.2 times higher than the entire GDP of the country. And Warren Buffett himself has said anytime it approaches 200%, you're playing with fire. Look, you can believe me or not. And the fact is, most don't. That's why we're in the bubble we're in. That's why we have the asset valuations we have. That's why the exuberance exists as it does. Because emotionally, people can't accept the fact that things are going to change, and they're probably going to change quite aggressively and quite rapidly in the near future. You've got a choice. You can stay with the herd, stay with the crowd, and be like the lemmings that just run right over the cliff. because the cliff's coming, folks. Again, I don't know when. No one does. No one knows how much or how long, but we're in the season that the cliff is coming. So you can be like the lemmings and go right over the cliff, or you can stop a minute, use some logic rather than emotion. And know it's tough, especially when it comes to money. There's a lot of emotion wrapped up around money, investing, and all that. But you can use some logic and realize, wow, this is the most common thing I've been hearing from folks. And it's shocking to me that I hear this. But when I point out that we're at the all-time high levels we've ever seen, PE ratios, anything you want to measure, ever in the history of the stock market, it is shocking to me how many folks say, I didn't realize that. I had no idea. And some of these folks are active investors. They're just gotten caught up in the hype. It's easy to do. I'm trying to shake a few people awake, say, do you realize where you are? You might want to make some changes or change your direction, or at least take some winnings off the table. Reduce your risk somewhat before the lemmings do indeed go off the cliff. And I like this article here where it points out history often repeats why this housing bubble and stock market could go bust soon. As they point out, there's 4 converging factors. We have an economic slowdown, consumer financial strain, unaffordable housing prices, and persistently high interest rates. These are all threatening the stock and real estate markets. For example, in real estate, momentum has shifted from bidding wars to falling prices. See, the signs are all around us, folks. We have negative feedback loops when it comes to jobs and consumer spending. Likely that's going to accelerate, not decelerate. As I stated in previous segments, about half of all consumer spending is now down to the top 10% of income earners in the United States. That's the highest levels we've ever seen. So a very small percentage of people are driving the economy. And as that changes or they decide to slow down, guess what the economy is going to do? And as this article points out, unless wages surge or long-term rates drop significantly, home prices are likely to revert to pre-pandemic levels as affordability remains at record lows. As they point out, he knows, I know a lot of people don't believe this, and they believe lower interest rates are going to keep home prices high or even push them higher. But the outlook, if you really look at it for housing, is very negative. Home prices have reached unprecedented levels, are at extreme bubble levels, exceed valuations far above the previous housing crisis from 2008. Bulls seem to believe everything will be fine as they point to a housing shortage, quote unquote, and the fact that loan underwriting standards are better now than they were before the great financial crisis. But as they point out, this could be flawed thinking. They see the 4 major factors converging that could lead to a housing price correction. The economy is slowing down. The average consumer is showing extreme financial strain. The past 4 years of inflation have just dried up the reserves, dried up people's savings, the average Americans, that is. There's historical levels of credit card debt. They're not taking on this credit card debt, folks, just for fun. Increasingly, people are taking on high interest debt like credit cards to pay for necessities. This doesn't end well, folks. We're getting closer and closer to a credit crisis for the average American consumer. Third factor, as they point out, is housing prices have hit extremely unaffordable levels. Home price declines are already happening, and declines could snowball as the economy weakens further. This is typically what happens. And the fourth and final factor they see is that interest rates are likely to stay elevated. I shared earlier where the Federal Reserve has said they project interest rates to stay higher for the next 7 years. And as this article points out, the only real solution to improve affordability is a large decline in home prices. Now, I know a lot of people have a lot of equity in their homes, and they're reluctant to reduce those prices because they don't want to lose that equity. But here's the reality of what is happening as we speak. Due to a number of factors, an increasing number of people will be forced to sell their homes. Could be through job changes, divorce, medical reasons, lifestyle changes, property taxes or insurance rates getting too high. There's families growing, more kids, they can't fit, they have to move. My point is this, more and more people as we go forward will be forced to sell regardless of what the price is. So they're going to be forced to lower the prices to get that sale. To be fair, real estate is a long, slow process. This is part of the reason I have not discussed the real estate stuff as much recently as the stock market, because that tends to move much, much faster. I see a similar likelihood of real estate prices adjusting fairly significantly. We're seeing that in some markets. Austin, for example, has already dropped average 20% from the peaks. That's an example. But real estate tends to move a lot slower because you're talking about millions of people and a large asset. It just moves slower than the stock markets do. My personal opinion, I believe we'll see a stock market correction, then followed by a real estate correction sometime thereafter. And that's the typical cycle. The 08-09 one was unusual that the real estate market, if you remember, dropped first. The stock market dropped about a year later. Both drops were significant. Many real estate markets saw drops as much as 50%. I saw it firsthand in Phoenix. The stock market dropped about 45% top to bottom during that time frame. The S&P 500, for example, was quite dramatic. It was called the Great Recession for a reason, but one of the canary in the coal mines is commercial mortgage delinquencies have now surpassed the 2008 financial crisis peak. Over 10% of commercial mortgages are now delinquent. Residential and commercial are different, but they do influence each other to a degree. This is some information put out by Fannie Mae stating that if U.S. income spiked 60%, we would return to pre-pandemic housing affordability. If home prices dropped 38%, we would return to pre-pandemic affordability. Or if mortgage rates fell to 4%, we would return to pre-pandemic affordability. Which of those is the most likely to happen? Probably be a combination of some of that, of course, but the least likely is the lower interest rates because of the high levels of debt. I discussed that in the first segment today and many previous shows. Now, Lennar, one of the largest home builders in the country, is showing the way. They're showing how to drive market sales, housing sales in this type of market. Lennar has cut prices an average of 22%, and they are now below pre-pandemic pricing. The result? Their sales orders have spiked. Existing homeowners, as this article points out, would be wise to take note. When you have new homes going for the prices similar or less even than what they were previous to the pandemic, existing home sales will eventually follow for the most part. They'll have to if they want to sell. And like I said, some will hold on and decide not to sell, but some will not be able to afford to do that. They'll be forced to sell for a number of reasons. So my opinion, my projection is we will see a significant stock market correction in the relatively near future. Protect yourself from that. Reduce your market risk. You can still gain unlimited upside potential while eliminating the downside risk. We have a number of annuity products that do that today, and we're in the golden age. Best rates, best numbers we've seen in 40 plus years. I know there's some negative connotation with some people with that still. The negative connotations, I spoke with somebody about that today. Those types of products where they say, well, you put it in there and they keep it and you never really get it out. Those products haven't been around for over a decade, about 15 years actually. So that's just holdover from some old stuff way back when. I get it. That doesn't exist anymore. There's way better products today. It's unreal. In fact, if you have an annuity that's over 2 or 3 years old, you really should take a look at the new ones. I can show you products that are going to get 2-3 fold likely upside potential. Even some of the guarantees are better than what you're earning now. It's that much better. Second prediction, at some time thereafter, we're starting to see it already, but a housing correction in prices, because something's got to give. It just can't stay this way forever, right? And that's just being logical, using common sense, looking at the factors, 26 years of experience being in the financial world, being self-employed, former chairman of the board of a bank, FDIC insured bank in formation, all those things. My biggest recommendation though, if you take one thing you take away from today, is look at your situation, really look at it, use some logic and common sense, try to separate the emotions. I get it, it's hard to do, but separate the emotion and look at how you can reduce your market risk. Again, I can show you how to continue to gain from the upside if it continues for however long that may be, but at least you can protect the downside and you don't have to ride the roller coaster up and then back down again and then wait for it to come back, which could take years. There's another option. There's another way. If you want to find out more, contact me at yourpersonalbank.com. I encourage you to stay tuned next week to the Your Personal Bank Show, and as long as it's on our money, in God we trust.
Listen Tuesdays at noon and Saturdays at 1 to the Your Personal Bank Show for more information. Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Dividend rates and bank line of credit rates may change. For current rates, contact Ferenc at 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422 or yourpersonalbank.com.